Welcome to the Asian Connection Mortgage Podcast, where we connect Asian Canadians together to talk about anything related to real estate, mortgages, and finances, based out of Vancouver. Our host is John Lee, mortgage broker with the Rise Mortgage. Grab a bubble tea and enjoy the episode.
Welcome to another episode of the Asian Connection Mortgage Podcast. My name is John Lee, mortgage broker, and today we're going to be talking about what you need to know about mortgages for closing pre-sale properties. So I've been helping quite a few clients lately who have purchased a property 3 to 4 years ago, and now in this year, 2025, their pre-sale property is closing, and I'm helping them with their mortgage. Now, some are quite straightforward, some haven't. Because when they first purchased the pre-sale 3 or 4 years ago, things were a lot different. So one big thing is that interest rates. So interest rates, when they bought it 3, 4 years ago, well, it was really low. It's like probably 1.5%, 2%. Well, now I wish we are able to get those 1 to 2%, but now we're probably looking at about 4 to 4.5%. And if the pre-sale property was closing, say, 4 to 6 months ago, so I'm recording this in March, rates were as high as like 6 to 6.5. So that was a big shock for lots of people. Number one shock would be the payments, obviously. Before they were thinking like, oh, well, my payments will be based on 1 to 2%. No one would have thought that their payments would be based on such a high interest rates. Higher, but not like 6.5%. And number two is because of higher rates, well, now their qualification is a lot different. It's going to be the borrowing power will be less because rates have gone up, payments are going up, and therefore, with the same income, they can only afford a certain amount. So those are two things that have been making it difficult. As now, well, there are these challenges, but no, there are positives. So, past few years, the government have implemented a couple of great things, especially for people who are buying to live in and first-time home buyers. So if you do have a pre-sale that's coming up, closing, and if it is 1.1 million or less, your property transfer tax will be exempt. That's huge savings. So you won't need to allocate that for closing costs. You'll just be saving a lot. And also, if you are first-time home buyer and you have less than 20% down, and if the property is 1.5 million or less, then you can qualify using a 30-year amortization instead of a 25-year, which will allow you to borrow slightly more because at 30-year amortization, your monthly payment will be slightly less. So let's kind of go through three different scenarios that I've seen when I'm helping out with clients close on a pre-sale. So number one, I mentioned when they bought it, they're expecting low rates, and now when they are closing, payments a lot higher, they're shocked and they're very concerned. Some people may be looking into even renting, right? So now, before they were thinking the rent can cover expenses or even just maybe even break even, but now they have to chip in into the property. So what I would do is I would see how much they can qualify and try to minimize the monthly payment as much as possible. So if they can qualify using a 30-year amortization, just right away, I would start with that payment. Because what I find is that even at a third year amortization with a slightly higher rate, they will still need to chip in money into the property every month. However, it's not as much and it tends to be still manageable. Another solution is to see if they can put down a higher down payment. Um, when rates were low, everyone was just trying to borrow as much as possible because they're like, oh, it's free money. No one talked about prepayments. No one talked about increasing their monthly payments so that they can be mortgage free faster. Rarely did I hear that. But now that rates are higher, the conversation of prepayments, how much can I put in every single year? How much can I put down? That those type of questions are coming back, and I get it because the idea is okay, well, if I have say 50,000 and my interest rate is say 4.5, well, can I use that money elsewhere and get a better return? And likely, yes. No, you can still probably get maybe 7 to 10% if you invest in a uh, more equity-based portfolio. But for those who are like, oh, I want to be a little bit more conservative, I want to put in a GIC or just savings account. Well, saving 4.5%, that's actually pretty good. So they take that. So instead of borrowing the maximum, which maybe like say 80%, they might only borrow 70 or 60%. And that way their payments will be lower. Number two scenario that I've seen, and this is a really tough one. Um, it is that the appraisal is coming in lower than what my client is purchasing at. So, for example, on the contract, they purchased the place for $1 million. And now an appraiser goes in, looks at the place, looks at the sold stats and comparables around the area, and they found out that it's actually not 1 million. It's not worth that much. It's only worth, say, $900,000. So what happens in that case? Well, banks, they can still secure the property, but they're not going to see your property as 1 mil anymore, even though that's how much you're purchasing at, and that's what the paperwork shows. They're going to base it off of the appraisal value, which is 900,000. So if you're borrowing 80%, instead of borrowing 800,000, which is what it will be if the property was 1 mil, they're going to be lending you only 720,000, which is 80% of 900,000. Well, so what? Well, that means the client, the buyer, they need to fork out an additional 80,000. And for some people, they may be able to get that. Some, well, they can't. And they just need to scramble and get that $80,000 somewhere. So definitely plan ahead. Um, this is happening especially in the condo market. Uh, I find that when there's uncertainties or recession, condos are usually hit the hardest because there's just so much more supply than, say, a single detached house. So plan ahead, talk to your realtor, and just to get more information of the surrounding areas or even on the same in the same building as well. If you notice that a same suite with the exact layout that is like 2 or 3 floors higher than you, and it is being appraised lower than you, than your purchase price, very likely your value will be even lower. So plan ahead, make sure you have more cash on hand in the event that the appraisal value is coming in lower. Last situation that has come up often is the completion date being delayed. I feel for those who are looking to move in, they're getting married, they time everything, and they get a notice, and the developer is like, "Oh, just letting you know, the project is 1 year delayed." So now they have to scramble to find a place to live, maybe rent for a time being, or going back to parents, staying in the basement temporarily. So this is happening because some of these projects they were built during COVID time, and during COVID time, it's just things were moving very slowly, and also a lot of developers they're having a very difficult time managing their costs because rates have gone up so much. Inflation is also going a lot, so the cost of these materials it has gone up drastically. Um, and labor has also gone up. So just everything that you can think of that that the developers are hoping that will not happen happened. And I'm sure if you read on the news, many of these developers, maybe less well known, they're claiming bankruptcy uh, and going through this foreclosure. Lenders are taking back the property. So things like these happen. But say the developer is strong, but it's just they just need more time. Uh, so prepare for that and to um, be able to make sure you maintain your finances and not make any big changes. So if you're looking to purchase a car or I don't know, taking on some larger debt for whatever reason, you need to wait. Like if you have that pre-approval set in, but there's a delay, you need to make sure that you continue to maintain the finances for debts and not just the debts, but also your income as well. Don't don't quit your job. Make sure your income is continuing to be as stable as possible. So things that you would consider if you do have a pre-sale that's coming up. So I would say like 6 months before closing, that's probably a good time where you should contact your bank or contact your mortgage broker. That's a good time to get the ball rolling, have initial conversations on how to structure the mortgage, what to look out for, what are the strengths or some of the things that you need to be aware of, so that we could create a strong profile when we do submit it to lenders. Make sure you know how to get your documents. So documents like letter of employment, pay stubs, making sure your down payment is ready. I know many of you will have a deposit already with the developer, but that's often not enough because there's also GST on top, and most of the time, you may want to put more on top of the 15-20% that you've already given to the developer. So that needs to be in your account, not moving, and just showing to lenders that this fund is ready. You probably want to do a preliminary review of your credit report. Many of you may be able to get a free copy, so not like a hard pull, but just a soft pull, just to make sure that there's no unpleasant surprises. Because if there's any uh, debts owing or something that would hurt your credit, this is a good time to start getting that fixed, so that when it is time to apply the official mortgage, then uh, your profile will be a lot cleaner. So 3 months before closing, that's probably a good time where you would want to be more serious to submit our documents and to submit an actual official mortgage application to a lender. Why is that? Is because rates tend to fluctuate, and if you want to lock in your rate, this is a good time. If you lock in rate, it's usually good for 4 months. So we start with three, just kind of giving the developer 1 month wiggle room in case they need slightly more time for closing. Uh, you have to, at this time, you probably want to make sure you know what your closing costs are. So I mentioned that if your property is 1.1 million and it's a pre-sale, yes, you don't need to pay property transfer taxes. It's great. But if it's more, well, it's a large chunk of money. Um, but even if you don't have to pay for it, there's also other fees that you need to consider, such as legal costs, appraisal fees, moving fees. So um, don't just focus on what the amount is on the contract. On top of that, there's probably a few $1,000s that you will need to set aside to prepare for. And 1 month prior to closing, that's probably when you will be getting an email from the developer asking you to schedule a time for a walkthrough. That is a really good milestone because if the developer is comfortable to invite buyers to the building, then likely it's probably 99% done because it's safe enough to go in. Um, and what I find is that once they do the walkthrough, generally the completion date will be about 1 month later, at most 2 months. At this time, you also want to make sure you have your team in place. So your lawyer for closing, your insurance broker as well. Uh, so the developer will also nudge you as well because they will also need that information from you. Yeah, like I said, if you are looking into purchasing a pre-sale, most of the time it is straightforward, but things have changed so much from the time you purchase. Definitely give yourself more leeway, give yourself more time to plan, so that the process can be as smooth as possible. So there you have it. Everything you need to know about pre-sales. Of course, I can't cover everything in this episode. If you do have any questions, feel free to connect with me. I'm happy to answer them. And I'll see you in the next episode.
Thank you for tuning in. If you enjoyed today's episode, please consider giving us a review and subscribing to our podcast on your favorite platform. Thank you for listening, and we'll see you next time on the Asian Connection Mortgage Podcast.